He withdrew $35,000 from his RRSP in February. His daughter needed help with the down payment on her first home. He thought he was being generous. He was also being efficient because he had read about the home buyers plan and knew that first-time buyers could withdraw up to $35,000 from their RRSP tax-free to purchase a home. What he did not know was that he could have done the same thing himself, not for his daughter, but for his own purchase, because he had been divorced for 6 years and qualified as a first-time buyer again, under a rule almost nobody knows about. He had been renting since the divorce. He wanted to buy a smaller condo for himself. He had the RRSP funds. He simply did not know that the Canada Revenue Agency resets the first-time buyer status for divorced and separated Canadians who have not owned a home for at least 4 years. He found out when I explained it to him at a community financial planning session in Kitchener. He had already made the RRSP withdrawal for his daughter and started the 15-year repayment clock on that amount. He could not undo it, but he could still use the home buyer's plan for his own purchase because the plan allows 2 separate withdrawals under certain conditions. When we looked at his file, he still had $80,000 in his RRSP above the $35,000 he had withdrawn for his daughter. He withdrew another $35,000 for his own condo purchase under the divorced person exception. Combined with other savings, he had his down payment. He saved the income tax that would have applied to a non-HBP RRSP withdrawal at his marginal rate, which at his income level would have been about $11,000. I spent 28 years inside the Canada Revenue Agency, in the International Tax and Benefits Division, and later as a senior reviewer of RRSP-related file disputes. The Home Buyers Plan is one of the most misunderstood programs in the Canadian tax system. Most people know it exists. Almost nobody understands who actually qualifies, how the repayment works, what happens when you do not repay on schedule, and the specific exception that resets eligibility for divorced Canadians. Today I am going to walk through all of it. But I want to flag something before we go through the details. The most expensive mistake I see people make with the HBP is not a mistake about the rules. It is a mistake about the timing. Stay with me until the end of this video, because the timing issue I am going to describe cost people thousands of dollars in tax they did not need to pay. It is the thing most accountants do not catch until it is already too late. Let us start with the basics, because even the basics contain surprises for most people. The Home Buyers Plan allows Canadian residents who qualify as first-time homebuyers to withdraw up to $35,000 from their RRSP to use toward the purchase of a qualifying home. If you and your spouse both qualify as first-time buyers, each of you can withdraw up to $35,000 for a combined household withdrawal of up to $70,000. The withdrawal is not taxed at the time you take it. Your financial institution does not withhold income tax. The money comes out of your RRSP clean, with no deduction. This is the part that makes the HBP valuable. RRSP withdrawals are normally taxed as income in the year you withdraw. A $35,000 RRSP withdrawal for a person in a combined tax bracket of 30% generates $10,500 in income tax. The HBP eliminates that tax at withdrawal by converting the withdrawal into a repayable loan from yourself to yourself. The catch is the repayment. You must repay the withdrawn amount back to your RRSP over 15 years. The repayment starts in the second calendar year after the year of withdrawal. If you withdrew in March of this year, your first repayment is due by the end of next year. Each year, the minimum required repayment is 1/15 of the original withdrawal amount. For a $35,000 withdrawal, the minimum annual repayment is approximately $2,333. Here is where the misunderstanding that costs people money appears. If you do not make the required repayment in a given year, you do not simply miss the payment. The amount you were required to repay that year is added to your income as if you withdrew it from your RRSP without the HBP protection. You pay income tax on it at your marginal rate, and that portion of the HBP balance is treated as repaid for future purposes. Most people who miss HBP repayments do not know they are being taxed on the missed repayment. They see no withholding at source, receive no immediate bill, and discover the issue only when their tax refund is smaller than expected or when they owe tax at filing. The amount is added on line 12900 of the tax return. If the HBP repayment schedule is not proactively managed, it silently creates taxable income year after year for 15 years. I sat with a woman called Sandra, who had used the HBP 12 years earlier to buy her first home. She had made repayments diligently for the first 3 years and then stopped when she had other financial priorities. She had no idea that missing the repayments for 9 years had generated 9 years of added taxable income. When we calculated the cumulative tax she had paid on those missed repayments, the total exceeded $6,000 in income tax she had paid over 9 years on amounts she thought she had already handled by opening her RRSP contribution statements and assuming everything was in order. She had not been notified. The added income appeared on her returns each year. Her accountant had processed it correctly. Nobody had flagged it or explained that the added income was a consequence of missed HBP repayments. She thought her RRSP contributions each year were for retirement savings. She did not realize that until the HBP was fully repaid, contributions did not automatically go toward the repayment. The HBP repayment must be specifically designated on your tax return using Schedule 7. If you contribute to your RRSP but do not designate the contribution as an HBP repayment on Schedule 7, the contribution is treated as a regular RRSP contribution, and the HBP repayment is still considered missed. You pay tax on the missed repayment, and you get to use the contribution as an RRSP deduction. It is not a disaster, but it is not what most people intended. The way to manage HBP repayments is straightforward. Each year, make a contribution to your RRSP of at least $2,333 if your HBP withdrawal was $35,000. On Schedule 7 of your tax return, designate that amount as an HBP repayment. You can designate more than the minimum if you want to pay off the HBP faster. Once the HBP is fully repaid, your RRSP contributions return to their normal function of generating retirement savings and RRSP deductions. Now let me explain the first-time buyer definition in detail, because this is the area where the most eligibility questions arise. A first-time homebuyer for HBP purposes is a person who has not owned a home that they occupied as their principal place of residence at any time during the preceding 4 calendar years. Not 4 years from today, 4 calendar years. That means if you sold or vacated your last home in any month of 4 years ago, you may already qualify as a first-time buyer again right now. The 4-year look-back means that many Canadians who owned homes in the past qualify again after a long period of renting, and it means that the divorced person exception I mentioned at the start is not really an exception at all. It is simply an application of the standard rule. A person who divorced 4 or more years ago and has been renting since then is a first-time buyer under the ordinary definition. They have not lived in an owned home as their principal residence in the past 4 calendar years. The plan does not require them to be buying their very first home ever. It requires them to meet the 4-year look-back test. I want to emphasize this because I have seen many divorced or widowed Canadians assume they cannot use the HBP because they owned a home with a spouse in the past. If it has been more than 4 years since they lived in an owned home, they are eligible. No exception required. The plan applies to them as it applies to anyone else who meets the look-back test. There is also a specific provision for people who become eligible due to the breakdown of a relationship. If you are legally separated or divorced, and you did not occupy the home you owned jointly with your former spouse in the current year or the preceding 4 years, you may qualify even if you technically still have ownership interest in the property, for example, if the property is still being sold as part of the divorce settlement. This is a narrower technical provision, but it matters for people who are in the middle of a divorce proceeding and want to use the HBP to establish their own home. The eligibility rules for this situation are specific and require a letter from a lawyer or the property title situation to be carefully reviewed. Consult a tax professional before relying on this provision if your ownership situation is complex. Now let me address the timing issue I flagged at the beginning because this is the one that costs people the most money and gets the least attention. The withdrawal from your RRSP for the HBP must occur no earlier than 90 days before the date of your purchase agreement. Let me repeat that. The 90-day rule applies looking backward. If you withdraw RRSP funds and then do not purchase a home within 90 days, the withdrawal may not qualify for HBP treatment. In practice, most people make the withdrawal close to their purchase date, and this is not an issue. But the more significant and less discussed timing rule is the other direction. You must purchase or build a qualifying home before October 1st of the year following the year of your withdrawal. If you withdraw RRSP funds in good faith expecting to buy a home, but the purchase falls through and you do not complete another purchase by the deadline, the withdrawal is treated as regular taxable income. You pay tax on it at your marginal rate with no HBP protection. This happens more often than people realize. A buyer makes an RRSP withdrawal anticipating a closing. The deal falls apart due to financing, inspection issues, or the seller backing out. The buyer cannot find a replacement property before the October 1st deadline. The withdrawal becomes taxable income. For a $35,000 withdrawal at a combined marginal rate of 32%, the unexpected tax bill is $11,200. If this happens to you, contact the CRA immediately. There is a provision to reinstate the RRSP withdrawal if the home purchase does not proceed. You repay the withdrawn amount to the RRSP by the deadline for your RRSP contributions in the year following the failed purchase. This reinstates the funds without tax consequences, but you must act quickly, and you must know this option exists. Most people in this situation discover they owe tax at filing time, months after the deadline to avoid it has already passed. Let me now walk you through the practical steps if you are considering the HBP for a purchase in the next 12 months. Step 1. Confirm your eligibility. Check whether you meet the 4-year look-back test. You can verify this through your CRA My account by checking whether you have any active HBP balance from a prior withdrawal. If your HBP balance is 0 and you have not lived in an owned principal residence in the past 4 calendar years, you are eligible. Step 2. Ensure the funds have been in your RRSP for at least 90 days before you withdraw them for HBP purposes. Contributions made in the 90 days before the withdrawal do not qualify for HBP treatment. If you plan to make a last-minute RRSP contribution and immediately withdraw it for the HBP, the contribution must have sat in the RRSP for 90 days first. Step 3. Submit the HBP withdrawal request to your financial institution using CRA Form T-1036. This form authorizes the financial institution to release the funds without tax withholding under the HBP rules. Step 4. Complete your home purchase before October 1st of the year following the withdrawal. Step 5. Starting in the second calendar year after your withdrawal, designate your annual RRSP contributions as HBP repayments on Schedule 7 of your tax return. Do not assume your RRSP contributions are automatically applied to the repayment. They are not unless you designate them. I should say clearly I am a retired civil servant, not a licensed financial or legal advisor. The HBP rules are detailed, and your specific situation may have wrinkles that require professional review. Contact a CPA before making a large RRSP withdrawal under the HBP to confirm your eligibility and the tax implications if the purchase does not proceed as planned. The man I mentioned at the beginning, the one who withdrew for his daughter and then discovered he could use the plan for himself, closed on his condo 4 months after we spoke. He designated his RRSP contributions as HBP repayments on Schedule 7. He understands the 15-year clock. He is managing it intentionally. He saved $11,000 in income tax on the withdrawal he made for his own purchase. That $11,000 stayed in his account instead of going to the CRA. He had paid into his RRSP for 30 years without ever being told that a significant withdrawal for a home purchase could be entirely free of income tax at the point of withdrawal. He simply needed someone to explain it before he made his decisions, not after. One final point for parents who want to help their children buy a home. The HBP is personal. You cannot use your own RRSP for someone else's purchase. But you can gift money to your adult child, and they can contribute it to their own RRSP, wait the required 90 days, and then withdraw it under the HBP. The gift is not taxable. The RRSP contribution generates a deduction in your child's hands. The HBP withdrawal comes out without income tax. This is not a loophole. It is the intended use of the program. The man in Kitchener wishes he had known this before making the first withdrawal for his daughter. He could have structured it differently and preserved both of their HBP eligibilities in a cleaner way. He learned it in time to help himself. Use this knowledge carefully before the RRSP withdrawal is ever made. That is what matters most.